Hey guys, welcome back to another video. Today we will be covering the Chapter 1 questions from the Investment Banking, Valuation, Leverage Buyouts, and Mergers and Acquisitions 2nd edition textbook by Joshua Rosenbaum and Joshua Pearl. It is a fantastic overview of the investment banking space and the technical questions that you may face at entry-level interviews or in a first or second year position as an analyst, as an investment banker, or even an equity research analyst. It covers all the different technical tools that will be used by investment bankers, and it is a fantastic overview. And so in Chapter 1, I already made a video covering the full chapter and the comparable companies analysis. And so I would recommend that you watch that video. It is relatively long, so hopefully you can watch it in pieces, but it covers everything you need to know about the comparable companies analysis from start to finish, and it is a fantastic overview. And so in this video, I'm going to be covering some questions from that we talked about in that video and some of the topics that we learned about. Okay, so let's get started. So question 1, which of the following is the correct order of steps to complete the comparable companies analysis? So I'll give you some time. Now, the correct way is to first select the universe of comparable companies, right? You want to find out which companies you're comparing your target to. You then locate the necessary financial information. You then spread the key statistics, so you input all of that financial information and you calculate the different multiples that are necessary. You then benchmark the comparable companies and finally determine the valuation. So really looking at this, like the proper order would be 2, select the universe. 1, locate the necessary information. 3, spread the key statistics and ratios. 5, benchmark the comparable companies, and then 4, determine the valuation. So in that order, the correct answer, so 2, 1, 3, 5, 4 is letter A. So A would be the correct answer in this question. Question 2, which of the following are the key business characteristics to examine when screening for comparable companies? So when we're talking about business characteristics, we're trying to determine the business profile of the business so that we can really understand if it is a true comparable to our target company. So sector would be important, but return on investment is more of a financial metric than a business characteristic. So we'd exclude that. End markets is a very, very important characteristic, so is distribution channels, to really determine whether the business is serving the same customers and therefore susceptible to the same cycles of the economy. But return on assets would not be, because it is, again, another financial metric. So 1, 3, and 4 would be the business characteristics that are important for screening comparable companies. So the answer would be C. Okay. Question 3, which of the following are key financial characteristics to examine when screening for comparable companies? Well, from a financial characteristics perspective, we're looking at the performance of the company and some financial measures to determine if it is size-wise and profitability-wise similar to the comparable companies. So customers would not be financial characteristics. Profitability will be. The growth profile is very important, that it is a metric of financial performance. The credit profile is also important, but the end markets isn't. So the correct answer for question 3 would be 2, 3, and 4. So B would be the answer to that question. Now, question 4, which of the following is not a source for locating financial information for comparable companies? The 10K is the annual report. 13D, I don't think it's 13D. Investor's presentation is another source of financial information, and equity research is a very important source of information, and a lot of analysts refer to their own investment bank's equity research department or others on the street. So the answer in this case, which is not a source of locating financial information, would be 13D for question 4, right? So selection B. Now, question 5, which of the following is the correct calculation for fully diluted shares outstanding when used in trading comps? This is a very important question to understand. This will probably be asked in the technical side of an interview. Fully diluted shares includes basic shares outstanding, plus in-the-money options and warrants, plus in-the-money convertible securities. So the answer would be B. It's basic shares outstanding plus in-the-money options and warrants, plus in-the-money convertible securities. Okay. Now, question 6, which methodology is used to determine additional shares from the in-the-money options and warrants when determining fully diluted shares? Well, the method that we use to calculate the new incremental shares from in-the-money options and warrants is the Treasury stock method. And we talk about this method. We go through many examples in the video. So once again, I recommend that you watch the full chapter 1 video on my channel. We talk about it in depth, and we really use a real world example to calculate the new incremental shares for the Score. It's a technology company based in Canada, and we look at its actual balance sheet and determine the numbers, right? So the answer to question 6 would be A. The Treasury stock method is used to calculate the additional new incremental shares from the in-the-money options and warrants. Okay, now question 7, calculate fully diluted shares using the information below. Okay, so now we have to use the Treasury stock method to calculate the fully diluted shares. So we know basic shares outstanding of 200, and we don't have any convertible securities, convertible equities. So therefore, the only calculation is we have to calculate the in-the-money options. And so we have exercisable options of 20, and the weighted average exercise price is $10. So it's below the current share price of 25, therefore it's in the money. So what we have to do is we have to calculate the new incremental shares using the Treasury stock method with this information. And so I can do it with you. So let me just pull up my handy dandy calculator. So the Treasury stock method, and just a quick overview, you can watch a fuller example in the other video. Essentially what you're doing is you're calculating the proceeds to the company from the shareholders, the option holders who would exercise these 20 options at a weighted average price of $10. So it'd be 20 times 10. So the proceeds to the company would be $200. The company then divides that, because they're using all of those proceeds to buy back shares at the current market price. So they divide by the current market price of $25 a share to buy back 8 shares. So from the 20 exercisable options, once they issue these new shares at the price of $10, they will buy back 8 of those 20 new shares. So net new incremental shares will be 12. It will be difference between what has been bought back and what has been issued, right? And so with basic shares outstanding of 200, 12 plus 200 is 212. So the answer would be C. And so that's what we see right over here. So really very, very important method. It is used on a daily basis when you're conducting comparable companies analysis. Okay, question 8. What is the most constructive or most conservative or most dilutive way to treat options and warrants when calculating fully diluted shares outstanding? And so this is another very important thing to understand. So when we are conducting a comparable company analysis or a precedent transaction analysis, we can make a decision. Either we can include the vested options or the vested plus unvested options. So do we include all outstanding in the money options and warrants, or do we use only all exercisable in the money options and warrants, right? With all outstanding, which are vested and unvested, it is much more dilutive, so it's much more conservative. And so in this case, it would be A. We would use all outstanding in the money options and warrants. Really, this is at the discretion of the banker. For a comparables company's analysis, they can either choose to use all outstanding or all exercisable. But in a precedent transactions analysis, you have to use all outstanding in the money options, because the unvested options are a future liability of the company. And when a company is being acquired, it will cease to exist as its current entity. And therefore, those future obligations need to be accounted for. And therefore, you're including all of the unvested options as well. Okay, so question 9. What is the formula for calculating enterprise value? Another very important question. Well, it's equity value plus total debt plus preferred stock plus non-controlling interest minus cash and equivalents. So the correct answer would be equity value plus total debt plus preferred stock plus non-controlling interest minus cash. So it would be B. That would be the correct answer for the enterprise value. Question 10. And by the way, you can pause the video and try to answer them yourselves, but I'm just going to quickly go through them. Now, question 10. All else being constant, how does enterprise value change if a company raises equity and uses the entire amount to repay debt? Now, the thing about enterprise value, the reason why a lot of bankers use it when conducting a comparables company's analysis, is that it is unbiased towards capital structure. So if a company chooses to have more or less debt, it won't impact its enterprise value. So this question is relatively easy to understand. That raise in equity will be offset by the decline in total debt. Therefore, enterprise value will stay constant. The answer is A. And this is the reason why, the multiples that are used in comparable companies analysis are based with the numerator as enterprise value. Okay, question 11. Which of the following is not an appropriate valuation multiple? Enterprise value to EBITDA, enterprise value to EBIT, enterprise value to net income, or enterprise value to sales? Another big thing that we talked about in the video, I spent a lot of time explaining this, so I'm only going to quickly explain it now. The answer, which of the following is not an appropriate valuation multiple, would be C. So for enterprise value multiples, the denominator employs a financial statistic that flows to both debt and equity holders, such as sales, EBITDA, and EBIT. Thus, enterprise value to net income is incorrect because net income only flows to equity holders as it is net of interest expense. The interest expense has already been paid out to debt holders, and therefore that net income is only flowing to equity holders. Whereas with enterprise value, it includes both equity and debt holders, and therefore it is a wrong multiple to use. Question 12. The price to earnings ratio is equivalent, the PE ratio is equivalent to what? Well, from the price to earnings, we talked about this in the video. Price to earnings is an equity value multiple. So really we can already cancel out B and C because it would not be correct. It does not consider enterprise value. And really the answer is A. It would be equity value divided by net income. Essentially, price to earnings, if you were to multiply the current share price by fully diluted shares and then multiply the current earnings per share by fully diluted shares, you would get equity value and net income. So really, this is the equivalent ratio. So the price to earnings ratio, the PE ratio, is equivalent to the equity value divided by net income ratio. Okay? And so that's the answer. So it would be A. Now, question 13. When calculating an interest coverage ratio, which of the following is not used in the numerator? Now, this is another good question. These are tough questions, especially if you've never looked at this before. Now, you have to think of the interest coverage ratio talks about the ability of the company to cover its interest expense, right? So which of these metrics would already have accounted for interest? Well, EBIT is before interest, EBITDA is before interest, and EBITDA net of capex is also before interest, whereas net income is after interest. Therefore, net income would not be used as the numerator in the interest coverage ratio. And EBIT, EBITDA, and EBIT net of capex can all be used dependent on, what the banker wants to display. So A would be the answer. Question 14. Show the necessary adjustments and the pro forma amounts if a company issues $200 million of equity and uses the proceeds to repay debt. So this is an enterprise value question, and it perfectly displays number-wise how enterprise value is unrelated to the capital structure. So in this case, the company issues $200 million in new equity. So it raises that money and then uses it all to pay down debt. So we know that the adjustment, first of all, total debt will decline by 200, right? So the first adjustment will be 750 minus 200, so we will have $550. And at the same time, equity value will also increase, right? Because now you're raising the amount of money. And so that's really the adjustment right over here. So equity value increases by 200 to 1,400, whereas total debt declines by 200 to 550. And so that offsets each other. So really there's no change net overall, and enterprise value from one year to another does not change. And that is why, enterprise value is unrelated to equity structure, the capital structure, and that is why it's the best apples to apples to comparison metric to use when comparing different companies with different capital structures. Okay, and then the final question, question 15, calculate the adjusted net income, EBITDA, and EPS respectively, assuming $50 million of depreciation and amortization and adjusting for the $10 million restructuring charge as well as an inventory write-down of $5 million. Okay, and this is another good question because in the video we talked about, and in the chapter's video, we talked about adjusting for non-recurring items. So in this case, is depreciation and amortization a non-recurring item? No, it is a recurring item, and therefore it should be included in the calculation of the adjustment. But this restructuring charge and inventory write-down are non-recurring items, and therefore to really display the normal business operations and strength of the business when you're calculating these multiples, you have to adjust for these charges, right? So in this case, you'd have to take away the $10 million of the restructuring charge, and at the same time you'd have to lower COGS because this inventory charge needs to be accounted for, so COGS would be lowered. And so when we adjust for that, we can adjust for operating EBIT. So really we're adding the 10 plus 5 million, and we're adding that to EBIT. So EBIT would actually be 150 rather than 135. For adjusted EBITDA, in that case, we would add 150 plus the 50 million in depreciation and amortization to get adjusted EBITDA of 200 million. And so those options are available to us. So 185 million would be incorrect and 185 million would be incorrect. So it's either B or C. And then at the same time, we can now calculate net income. So based on that, the adjusted net income, we have to apply a tax charge to it, right? So our current net income is 60 million, right? Now, does net income change because of this? Yes, it does. So we can assume that net income is not going to change. So the answer is B. And so here's a fuller analysis of that. So we are adjusting COGS by lowering COGS because the inventory write-down raised the cost of goods sold. So we're lowering it to $620, and at the same time, we're taking away the restructuring charge. So our operating income, our EBIT, we add 15 million or $15 to it. So the new operating income is 15. Now for net income, we have to tax affect it because there's a tax rate applied to this. So I can pull this calculator out and we can just do 15 times the marginal tax rate is 40, so it'd be 0.6. So the after-tax adjustment necessary to net income would be 9. So we add the $9 to the 60 to get an adjusted net income of 69. So we get adjusted EBITDA, because with EBITDA, we already know the depreciation amortization is 50 million. So we add that to the adjusted EBIT of 150. So we get adjusted EBITDA of 200 million. We get adjusted net income of 69. And of course, you have your EPS of 2.3, which is once we calculate with the weighted average diluted shares. So that's pretty much it. The answer is B. Other than that, that's pretty much it for the chapter and some of the questions. If you do have any questions regarding this chapter and the questions that we talked about in this video, I can kind of explain it more in the comment section. If you did find it helpful, please do subscribe to the channel and like the video for more. I would recommend that you watch chapter 2. In chapter 2, we're going to be talking about present transactions analysis. In chapter 3, I'm going to be talking about the discounted cash flow model. In chapter 4, I'm going to be talking about the leveraged buyout analysis. And, I'll also make relevant videos for those as well. So there are going to be tons of videos available for you if you are preparing for your investment banking interview. So I do recommend that you continue to watch some of these videos. And if you have the time, it's really, really important to really speak to these instead of remembering them and regurgitating that information in the interview, that you fully understand the analysis and the thinking behind why we make these necessary adjustments and why we follow these processes. So as always, thank you so much for watching, guys, and have a great day. Thank you.